Hello again. In this video, we will be focusing on supply zones. Recall, a supply zone is where an institution puts in a leveraged sell order where they are setting multiple limit orders to sell an asset at a specific price. Identifying supply zones is pretty much the same thing as identifying demand zones, but flipped. This time, instead of looking for a small green reversal candle followed by a strong-bodied green candlestick, we will be looking for a small red reversal candle followed by a strong-bodied red candlestick. Same thing goes here where the reversal candle may be green, but since supply zones that have a red reversal candle are generally stronger zones, we'll primarily be using examples that involve a red reversal candle. Taking a look at the setup of these candlesticks here, we can identify the supply zone by this time marking a rectangle from the bottom of the small red candlestick's body to the high of the two candlesticks that make up the formation. Of course, if the reversal candle is green instead of red, we would still use the bottom of the green candlestick's body to mark the low of the zone. Notice here, the rectangular zone ranges from the bottom of the small red candlestick's body to the two candlestick high. The same rule applies here, where if the second red candle in the formation makes a higher high than the small bodied candle, then we'll be using that high to identify the range of the supply zone. Let's go ahead and take a look at some examples of supply zones. With this first setup here, we have a small-bodied red reversal candle accompanied by a strong-bodied red candlestick. This, of course, is the setup that we are looking for to identify a supply zone. So what we can do is mark this zone from the bottom of the small red candlestick's body to the high of the two red candlesticks. By doing this, we have just identified a supply zone on the 1 hour time frame. As we watch price develop, when price re-enters this zone, it quickly shoots back to the downside as institutional orders are being filled there and the imbalance between supply and demand, where there is more supply than demand, is pushing the price back downward. Taking a look at this example here, we notice a similar setup with the same two candlestick formation where there is a small red-bodied reversal candle followed by a strong-bodied red candlestick. Once again, we can use these candlesticks to identify a supply zone by creating a rectangular region that ranges from the bottom of the body of the smaller red reversal candle to the high of the two candlesticks. Doing this has allowed us to identify a supply zone on the 2 hour time frame. Now, as we observe the development of price on this chart, we'll see that when price re-enters this zone, there is a rejection due to the imbalance between supply and demand, and price moves into the downward direction. Let's take a look at another example here on the 4 hour time frame. Here are the two candlesticks that we can use to identify the supply zone, where institutions are establishing those leveraged sell positions. By marking a range from the bottom of the reversal candle's body to the high of the two candlesticks, we can now see exactly where the supply zone lies. But anyway, with this supply zone here, as we watch how price develops, the same thing that we saw in the last two examples happens here again, where price rejects in this region and moves back downward. Notice this time, the retracement back into the zone happened a lot quicker than the other two examples. But after retracing into this zone, there is a brief point in time where limit sell orders are being filled before price breaks back downward. As you can see, retracements into the zone can occur just a few candles after the formation of the supply zone. And even though it retested the supply zone sooner, the same principle applies where there is still that imbalance between supply and demand, which causes price to move downward. By the way, this also applies for demand zones, where price can retrace into the zone at any point and cause for the imbalance between supply and demand, resulting in a quick price movement. Supply zones are also not all going to have the same strength. The strength of the supply zone is directly related to the size of the red candlestick body that follows the red reversal candle. Similar to demand zones, the larger the body, the stronger the supply zone, and vice versa. If the second red candle's body is smaller, then that is likely to be a weaker supply zone. And as we know about the strengths of zones, the stronger supply zones tend to see stronger downside moves after retests of the zone. As we can see with this diagram here, the larger the red candlestick's body, the stronger that zone tends to be. Also, strong red candlesticks with small to no bottom wicks make for stronger zones as selling pressure was consistently strong during that session. Thus, the larger the body and smaller the wick of the red candle that follows the reversal candle, the stronger that supply zone is likely to be. Let's take a closer look at this concept to further understand how the strength of a zone works. We'll use two examples of supply zones on the 5-minute time frame and compare their strengths based on the size of the red candle that follows the reversal candle. With the first example here, we'll notice that there is a very strong-bodied red candlestick that follows the smaller red reversal candle. We can deem that this is a very strong zone due to the fact that the second red candle has a very large body and pretty much no bottom wick, which means that sell pressure was very high during that session. Anyway, let's go ahead and mark this supply zone and label it as a 5-minute supply zone. Now let's take a look at this second example here, where the second red candle has a much smaller body than the first example. Let's label this zone and mark it as being a weaker supply zone since the candlestick's body is smaller than the first example and there is a longer wick coming out of the bottom side of the candle, indicating that sell pressure was not as strong as the sell pressure that we saw in the prior supply zone. Going back to the first example here, as we watch this play out, we'll see a strong rejection off of this zone when price retests the region where a clean move to the downside occurred. The strong rejection could partly be accredited to the fact that this supply zone was constructed from a strong red candlestick that followed the red reversal candle. Due to the candle that established the region being so strong in terms of the length of the candle's body, a strong rejection followed on the retest of this level. Let's compare this to how price developed with the weaker supply zone. As we can see when this plays out, a lot weaker of a rejection initially occurred off of this zone, and price did not reject far before actually breaking through the zone entirely. This is partly due to the red candlestick that followed the red reversal candle being much smaller than the one that we saw in the first example. Therefore, the harder the initial rejection following the red reversal candle, the harder the future rejections is likely to be when price retests that level. Moving forward, different time frames also correspond to the strength of supply zones. The larger the time frame, the stronger the zone. This means that supply zones identified on the weekly time frame are going to be a lot stronger of supply zones in terms of rejecting price when compared to supply zones identified on, say, the 15-minute time interval. The bounce that occurs off of the weekly time interval supply zone is likely to be a lot stronger and see a larger move than the bounce and move that occurs off of the 15-minute time interval supply zone. Thus, the move that follows a retest of supply zone is proportional to the time frame that you are using to identify a supply zone. For instance, a move that follows a retest of a supply zone identified on the 15-minute chart is likely going to see a far smaller move in terms of a price difference when compared to a move that follows a retest of a supply zone identified on, say, the daily chart. By identifying supply zones on different time frames, what you may notice is that some zones will overlap when sifting through the different time frames. Overlapping zones will be stronger due to the fact that you have limit orders being set there that occur on multiple time frames, making the imbalance between supply and demand greater where there is far more supply than demand at hand. Let's move the trading view to take a look at an example of this. If I go ahead and take a look at these two candlesticks here, we have a small-bodied red reversal candle that is followed by a strong-bodied red candlestick. Now I can go ahead and mark a supply zone here by going from the bottom of the candlestick's body to the top of the wick, and now I have just identified a supply zone on the 2-hour time frame. Now notice when I go to the 1-hour time frame, I can also notice that we have identified another supply zone here. We have a red reversal candle followed by a strong bodied red candlestick, and now I can mark this supply zone as well. When I mark this supply zone here, we now have two overlapping supply zones, and if I go ahead and let this play out, what you'll notice is that we get a very strong initial bounce off of this level, as there are two supply zones working together to push the price downward, and price continues to make lower lows. Also, supply zones will not always have the same strength each time they are tested in terms of pushing the price of the asset back downward. As you may recall from the video about demand zones, a supply zone 2 will eventually become used up where there are little to no unfilled limit orders left there to create an imbalance between supply and demand. Thus, When there is no longer that great imbalance between supply and demand, then it is a lot easier for price to break through that zone and continue upward. Take a look at this example here, where price retested the same zone multiple times. Each time that it tested the supply zone, more and more of those limit sell orders were being filled, and when price came back to test it again here, there was no longer an imbalance between supply and demand, and this time price ended up breaking through the level. When price retests the same zone 3 to 4 times, that zone is generally pretty much used up, and it is unlikely that price will continue to reject with the same level of magnitude off of that zone as the imbalance between supply and demand is becoming less and less. This essentially would make the supply zone used up and no longer a valid location for an imbalance between supply and demand, making it a whole lot easier for price to eventually break through this level. Anyways, that will pretty much do it for this video on supply zones. In the next video, we will focus on how to enter trades in supply and demand zones, what to look for, and where to set a stop loss. Stay tuned to learn more.